Hi, Jim Curzan here, and welcome to the 2019 Halftime Report. Actually, this is the report on the second quarter, but since we're recording this about 5 weeks beyond the end of the quarter, we actually updated the slides through the end of July. As always, I try to come up with a theme to describe the events that are happening with respect to the economy and the markets. And I would have to say the theme today is alternative worlds. It's quite a bit different when we look at what's happening in bond land versus what's happening in stock land. Recently, we've been at all-time highs or near highs with the stock market. The economy seems to be performing fairly well, and there's no real sign of recession on the immediate horizon. That said, in bond land, we're looking for rate cuts. And pricing would indicate continued cuts, which would imply perhaps economic slowdown or at some point recession. The reason we do these calls quarterly is because the economy matters. It's important to understand kind of where we are in the economy and how it affects the markets. And it affects the markets in a number of ways: corporate growth, job creation, bottom line corporate profits, and the health of those profits, inflation, as well as interest rates. And we're going to today try to touch on some of these points. We do this in an attempt to answer two important questions. Where are we now in terms of the economy? And there can only be four places we can be. We can be in a recession, we can be in a recovery, we can be in a slow growth environment, which is kind of where we still think we are, or we could be dipping into an economic slowdown, which is the forebearer to a recession. At this point, we believe we're still in slow growth, maybe at the end of that cycle. And then the other thing is we want to know where we're heading. At Kaydan Wealth Management, the way we manage money, the way we allocate assets on behalf of our client, has a lot to do with our opinion on two important questions. One is where we are in the economic cycle, and these are things that we ask ourselves weekly. And also, what is our opinion on what the Fed will do next? We've got some clarity on that as they cut rates just last week. First rate cut in many years, and a change in their focus and bias. Today's agenda, we'll be talking about 5 subjects. One is recession risk rising and what that looks like. What is the future of inflation? We'll talk a little bit about the Fed and interest rates and what that might look like. We'll also talk about corporate earnings growth and just the health of those earnings as well. And then we will also talk about the global economic slowdown, and is that somewhat temporary? And what does that mean from an investment perspective? Let's start with the recession and the economy. This is a really interesting slide. First off, on the far right-hand side, you'll see consumer consumption at 68%. Call it 70%. Our economy is based on consumer discretionary consumption. As long as consumers are buying, as long as consumers are still feeling healthy financially and continue to spend, the economy continues to perform. On the left-hand side, we'll get a general sense for kind of where we are. And you'll see for the last 10 years or so, we've been somewhat muted. We haven't had terrific growth. We had a little bit of a spike here the last couple of years, growth in excess of 3%. That growth rate has kind of fallen to about 2.3% or so, which is actually a bit better than long-term average, or the average we've had the last, let's call it 10 years. A little bit beneath long-term average the last 50 years, because we haven't seen those huge spikes as we did in the 70s and early 80s. But at best, we would expect that the economy will grow and grow somewhat slowly. We don't see 4% growth. We do expect an acceleration in growth of GDP in the second half of the year. These slides are a little bit, I don't want to use the term, but somewhat troubling from the standpoint that we're beginning to see not necessarily a slowdown, but a pause in growth. And the question then becomes, is this temporary? Does this get refueled second half of the year? Certainly the cut that was made by the Federal Reserve last week could certainly spur on some additional activity. You can see in terms of residential investment, call that housing, that has slowed up. It's somewhat flattish to slightly down. We've also seen the same in terms of vehicle purchases as well. Those have also somewhat slowed down. The only positive is we're beginning to see in the upper right-hand corner business investment, business fixed investment. Companies are beginning to spend money again on capacity, plants and equipment, and that is a big, big component of GDP growth. So that's the only plus. The rest I would give it probably a B- average, something to watch, something to look at. If we don't see this improving, we would certainly look at, again, where we think we are in the economy, and it might very well indicate that we might be slipping into an economic slowdown. A lot of people are concerned about a recession and when it happens, what it might look like. No telling when it will happen. Certainly it will happen. All recoveries lead to recession. The interesting point, though, is we're pretty healthy from the standpoint of where we are right now. Should we be slipping into a recession? What I find interesting is when you look at periods of time in the past, as the government is starting to move from rate tightening to rate reduction, and usually that's as a result of the economy slowing down. The level and degree of recessions have been all over the place, very severe to somewhat muted. When we look at where rates are now versus periods of time in the past, when we look at where inflation is now versus various times in the past, we look at where Fed funds rates are now, 10-year yield, etc. You can see that from an economic perspective, rates are very, very low. We don't have huge borrowing costs. We have fairly low inflation as well. And that may indicate, should we see a recession at some point, that could be a bit muted. An interesting point is on the far right, using July 30th's date and about the fourth line item down, real yields on U.S. Treasuries. Right now, U.S. Treasuries are trading, well, at the time of the slide, they were trading at about 2-ish%. Inflation was also running at 2-ish%, which means that money in the bank, money in 10-year yielding paper is actually earning net of inflation a negative yield. And that's the first time we've seen that going into a rate cut. It hurts savers, and this is also before taxes. So if we were to actually apply a net after-tax, after-inflation rate, the yield that we're getting on our money is actually even worse than what's represented here. On the unemployment and wage front, unemployment continues to drop. It is running something in the order of about 3.7%. That is very low unemployment compared to the peak back in October of 2009 at 10%. What's interesting on the slide is that wage rates are starting to climb again. So you're beginning to see wage rates appreciating pretty significantly. The average rate hike yearly is 3+%, and in certain areas there are bidding wars for qualified candidates. At 3.5% unemployment, there's very few qualified candidates still available who are looking for jobs. And as a result, it pushes up wages. So this may indicate at some point down the road, we could see the beginnings here of some degree of inflation, kind of a wage push inflation scenario. For a second, let's take a look at the U.S. dollar as well and what implications that has on our economy. The chart to the left talks about the U.S. dollar, and we can see some relative strength here in the dollar as of late. The last year and a half, as the Federal Reserve was raising interest rates, the dollar was rising as well. Prior to that, we saw a sharp drop in the U.S. dollar. By the way, that coincided with a period of time when the international markets began to outperform the the U.S. market by a sizable amount. The most interesting slide, I would have to say, is the developed markets interest rate differentials. What this is the difference between U.S. and international 10-year rates. And you can see it's significant. It's well over 2%, meaning on average, the U.S. yields are 2% higher than they are elsewhere. That is driving the dollar higher. That is making international securities less desirable currently. The thing about that, though, is the U.S., in an effort to counterbalance that, is starting to lower interest rates, which should have an effect by reducing the dollar. When it reduces the dollar, it makes our purchasing power less attractive overseas. So as American consumers, we may actually see a little bit of a hint of inflation because things that we're buying abroad may cost us all a little bit more. One component of our economy that might not have a huge impact on inflation may very well be energy prices, specifically oil. And here's why. When we look at production, what the U.S. is producing today, and the growth of that, 43+% growth since 2016, and look at the amount of consumption, how much we're consuming over the same period, an increase of just 6.2%. We're at a point now where we're actually producing more oil than we're using. And as a result, that should put a cap on energy prices. That should not cause energy to be a big, huge component of inflation, and that would be considered a plus. This chart on inflation drives home that last point. If we look in the kind of the box above the squiggly lines, and you look at through June 2019, headline inflation, kind of benign, 1.7%. Core inflation, or it's called core PCE deflator, 1.6. Again, pretty benign, especially considering the fact that it's about half what the average inflation rate has been over the last 50 years. One of the big reasons for that is about the fourth line item down, energy CPI. It's actually a negative number. It's in deflation. And again, because our ability to produce more than we're consuming keeps a lid on that, and as a result, we're all enjoying somewhat relatively cheaper energy prices. So that's not a huge contributor to the speculation that we may see higher inflation cost. Let's turn for a second to the Federal Reserve and interest rates. It's important to get an idea of what they may plan to do. And there's a lot of discussion out there as to what the Fed's next move is, or to what degree they continue along the path they've chosen. What I like about this chart is it shows all the discount rate cuts and all the increases over the last 20 plus years. What's interesting is the very far right to the chart. You'll see this stair-stepped effect from late 2015, early 2016. Each one of those stair steps was a 25 basis point rate hike that the Federal Reserve put in place, bringing effectively the Fed's fund rate from 25 basis points to about 2.38%. What's interesting are the two colored lines to the immediate right, blue and then a brown line. The blue line represents the FOMC year-end estimates. These are the Federal Open Market Committee notes. These are this is the average vote and consensus on where they expect interest rates to be. The purple dot is their long-term target, which is 2.5%. They were at 2.38. We just had a rate cut of 25 basis points, which brings it to 2.13. And based on the Fed funds minutes, they're done. They're expecting one cut and then a resumption back at some point to 2.38. That should be in and around 2021. So not a whole lot of action over the upcoming year. That said, the bond market, which places bets on where the Fed is and what will happen and the general strength of the economy as well, that's completely independent of what the Federal Reserve does. They're anticipating significantly more cuts along the next couple of years. They're expecting rates to actually drop quite a bit between now and 2021. Almost a full 100 basis point difference between where the Fed thinks they'll be and where the market thinks they'll be. So that can dictate a couple of things. One, perhaps the economy is globally a bit worse off than people think. Maybe people are emotionally scared and driving bond yields down. It can also set us up for some disappointment if the market is pricing in a number of rate cuts and we don't quite see as many. The market will feel somewhat disenfranchised and perhaps drop a bit in value. Obviously, this can change on a regular basis. I would think, just as a personal observation, that the Federal Reserve would want to keep rates reasonably high going into the next recession, so they'll have some tools and weapons available to them to effectively cut from to help stimulate. If rates get down to where the market projects them to be, that's either because we're A, in a recession, or B, the Federal Reserve is counterbalancing a very strong dollar compared to other currencies. And if we entered into a recession at that point, that could be somewhat problematic because there's very little they can do from there. By the way, Europe is facing this at this very moment. In many cases, they've been cutting rates, and now across the board, there are many central banks in Europe which actually have negative interest rates, where actually you put money in a bank and you get a bit less back at the end of the year. Great for borrowing, not so great for saving. This next slide illustrates interest rates and inflation. And the big takeaway here is interest rates have dropped a ton the last 35 years, from a peak in 1981 to a low that we achieved a few years ago, and we're kind of, looks like, heading that way. All that while interest rates were falling, bonds were a great investment. As interest rates fall, bonds prices go up. Today, it's a lot more difficult to anticipate bond returns beyond the coupon or their interest rate because there just is no component of price appreciation. The big takeaway, though, coincides with a slide I referred to a while back, and that's the gray line. So the top line are nominal rates, the actual rate published in the economy at that time, and the gray line represents real rates, those nominal rates taking into consideration the inflation effect. And you can see today, when we look at the 10-year Treasury, we're actually through July at a negative real rate yield, meaning net of inflation. Again, this does not depict taxes, which is also a cost to holding many bonds. So it's something to consider. We're at a point where it may very well force individual savers out a bit on the risk curve, trying to get higher yield and sadly accepting a whole lot more risk. In all our portfolios, we really don't own any high yield bonds today. We think that's a bubble that is developing, and at some point, should the economy slow down, it'll be we think could potentially be a big problem. So as a result, much of what looks attractive is generally shorter term and much higher quality. Let's continue to carry the discussion on fixed income and bonds. This slide depicts yields on certain types of bond assets and how they're correlated to the stock market. So the x-axis talks about how tightly they're correlated to stock. As we move left to right, they become more correlated or move similarly to the stock market. As we move to the left, they become less correlated and a better defense tool against stock market risk. And then the y-axis really talks about yield. They're referring to a hedge-adjusted yield. But as we move up the axis, the bonds referenced on the chart will typically have higher yield. So if we look at where my laser pointer is at, that right there, the U.S. aggregate, is generally the average index that we look at when we talk about bond land. And it's kind of a hodgepodge of all kinds of different bonds. There are government bonds, mortgages, corporate bonds with varying degrees of credit quality as well. As we move out, because we're not getting much yield these days and we are trying to get more yield, we wind up looking at emerging market debt that's dollar denominated or local currency. We look at European high yield, which carries currency risk, and then U.S. high yield market. Convertible bonds are usually, they have less yield than high yield because you're given a conversion privilege to move into the underlying equity. And as such, it is very tightly correlated to the stock market. I think this is creating a potential problem for a lot of investors as they move out to gather yield. They're also shifting to the risk focus of their portfolio, and they have internal to the portfolio just a whole lot more stock equity risk than they need. In our practice, we have kind of hunkered down in a lot of short and intermediate term to provide the most protection against stock market volatility. Turning away from bonds, let's talk about stocks now. Market has been fairly strong. We've had a couple of kind of knee-jerk reactions here, especially surrounding the Fed move on interest rates. It was somewhat of a disappointment. And then certainly our president's tweets on tariffs and trade have also caused for some concern as well. We still think a lot of this is short-term and headline fear or technology driven, nothing substantial of yet. Looking for things that we look at and help us determine kind of the general health of the market. We look at S&P earnings and S&P earnings projections, and we also look at the makeup of those earnings. And what I can report is the market should report this year probably 6+% earnings growth for U.S. corporations. That is not by any means a bad year. In fact, it's a kind of an okay year in terms of earnings growth. We know we're not going to see a huge spike because we got that early on with the Trump tax cut. If there's anything that I'm watching closely, anything that I'm a little bit concerned about, it's where earnings growth is coming from as it would relate to times in the past. So what I mean by that is if we look at the chart up at the top, the kind of box that talks about shares of EPS growth, and we look at where we are second quarter of 2019 versus the, call it 17-year, 18-year average, here's the one area where I'm a bit concerned. And again, this can go on for a while, continuing the market to perform, but it's something we're watching very closely. In the past, we've seen fairly reasonable earnings per share growth, 7+% a year. That number is getting diminished here a bit. So through the second quarter of the year, we're at about 2.1% earnings growth, a bit anemic. But the real concern, the thing we're watching, is where those earnings are coming from. They're not coming from top-line growth. They're not coming from, hey, we're selling more stuff. We've got big, strong revenue growth. That's a little bit less at 2.2% versus 3.2. We're not seeing increased profitability, meaning, hey, we're actually keeping more and making more on every dollar of revenue we get. That number is actually somewhat negative compared to what it's been in the past. But the real issue, the thing that we're watching closely, is this whole issue about share count. Companies made a ton of money over the last couple of years, especially with the Trump tax cut, and they've been using it to buy back shares. So in the past, share count as it related to earnings represented about 0.3% of the total growth rate. A very small amount came from over time. We're using money on our balance sheet and we're going out and we're buying shares of stock back so we have less shares out there. So when we talk about earnings per share, the number is divided by less shares, so the number per share looks higher. Today, 2.1% of what is a 2.1% earnings per share growth number is coming from share count, meaning a lot of the earnings per share numbers that are reported are being manufactured as a result of a reduction in the number of shares outstanding. And that's something that we talk about in our weekly investment policy meetings. We're reaching out, receiving help and assistance from other investment firms that we have relationships with, reading their analysts' opinions as well to get a better sense. But it's something we're watching very closely. Continuing on the subject of stock and stock valuation, this chart depicts S&P PE values, and they kind of put it in a historic content. So here we are. Today, or through the end of July, the S&P is priced at about 17.15. That is, people are willing to pay $17.15 for every dollar of earnings. It's not important what the number is. What is important, or at least helpful, is what the number is in relationship to some other period of time. Some PE or another, one company's PE versus another. But if we're talking about the health of the overall market, which we're defining in this case as the S&P, it is somewhat helpful. By looking at all the different metrics, looking at PE, looking at cyclically adjusted PE or CAPE, looking at dividend yield, the amount of yield, the amount of dividend divided by share price, looking at price to book value or price to cash flow, which are great metrics to look at when comparing companies. Or if we look at the earnings yield spread, earnings yield is the inverse or the opposite of earnings per share. Is basically earnings per share divided by share price. And we compare that to an investment grade bond. Of all the different things we can compare now versus average long term, everything seems reasonably expensive, somewhat fully priced. Yields, dividend yields, I should say, are a bit lower. The CAPE ratio is a bit higher. PE is a bit higher. Price to book is certainly a little bit higher. Price to cash flow is quite a bit higher. The only thing that still looks attractive, and this is an argument for many that the market could go higher, is this EY spread or earnings yield spread. And it is still very high. And as long as it's high and positive, basically what it's saying is that if you were to compare corporate earnings as a yield and you compare that to what you're getting in bond land, you're still being adequately compensated for it. When that yield goes to zero, advantage goes to bonds as opposed to stock. So in this environment, it's still somewhat stock friendly. I know this chart is confusing. There's a lot of numbers. This talks again about the stock market, and it looks at stocks with a few filters and a lens. It's kind of deconstructing this PE and looking at what component of the market is cheap versus other components of the market. What I will share with you is if we look at the center two boxes, what you're going to look at is year-to-date returns, and these were through July as they related to the S&P, including dividend yield. And you can see growth companies have performed quite a bit better than value companies. And you can see that not only for the year, but you can also see that over the course of the last 10 years, which is the lower part of the set of charts. That said, the growth component of the market is really priced to perfection. Consider the Apples and Amazons of the world. Should there be any concern at all about consumer confidence, those values have the potential to drop and drop pretty quickly. If we look at the far right two boxes, and I'm really only interested in the top box, this talks about the current PE versus the 20-year average. And you can see, it doesn't matter what we own, we're a bit more pricey today than long-term average. But consider the difference between a growth PE versus a value PE. Value is much more cheaply priced. We're paying much less for every dollar of earnings. We feel, should this market have the ability to continue to grow, value stocks will do better. They tend to have this mean reversion. The winners become the losers and vice versa. Also, they just tend to be better priced, more yield, paid dividends. So we have a slight overweight toward value at this point. We saw late last year, when there was concern of an economic slowdown, Apple and Amazon both dropped pretty significantly, about 30%, over a fairly short period of time. There's a lot of air underneath those companies, priced to perfection. They could continue to perform, but we've got to see continued confidence with consumers. And if and when that abates, which it will in a recession, value stocks hold a bit more support to the portfolio. Let's talk about the components in terms of valuation. So now we're not looking so much as growth and value, we're dissecting even further into industries. What this is showing is very much in line with what we saw in the last slide. If you look at the top of the columns, you'll see various industries, materials, industrials, financials, technology, so forth. And then you will see year-to-date growth. And you'll see, technology, no surprise, up 33.3%. Conversely, healthcare only up 7%. When we compare things like consumer discretionary, like Apple, which makes great product, up almost 25%, and you compare that to something like a utility at 15%. At some point, there will be a change, and when there is a change, we will see this change in leadership, how it affects companies, and it will also change growth and value components as well. Let's talk about the worldwide growth for a second, international growth in particular. This is called a heat map. I like it because it kind of gives a general sense, very visually, on manufacturing. This is Global Purchase Managers Manufacturing Report, or the PMI report. This does not cover services, and much like the U.S., Europe is very service-based as well. Our economy is very service-based because consumers represent nearly 70% of it, but it gives a general sense for where things are. If we look at the U.S. and we go all the way over, you'll see that it's green to yellow. That represents that things are slowing down a bit. The number through June was 50.6. Anything above 50 means expansion. The economy is still growing. Anything below 50 would represent a contraction. This is also one of the reasons that a lot of the European countries have been cutting interest rates, and now the U.S. is cutting in response to that. That's more to do with the defense of the dollar. If you see the red in the middle of the page on the right-hand side, that's Germany. And kind of as Germany goes, so goes the European Union. So we have to kind of watch this. A lot of people are expecting a pickup in this activity and general strength in the international currencies over the course of the next couple of years as it would relate to the U.S. But we are looking at this very closely. Back in 2017, 2018, it was hard to find a developed country that wasn't showing expansion and in green. That's beginning to abate a bit. But it's not like it was back in 2008 and 9 where everything was solidly red. And there's varying degrees of this along the way. We talked about the mean reversion a while ago. At some point, the winners become the losers and the losers become the winners. Since the recovery began 10 years ago, the U.S. markets have done phenomenally well, up 345% or so over the course of the 10-year period. Our P's now are above 17, as I said, on the S&P. If we look at the international markets, all country world index, ex-U.S., so it's everything outside the U.S., we've also seen a recovery, but not to the same extent. That recovery was about 110% over the same period of time. And today, PEs are 13 plus times earnings, not 17 times earnings. We've seen periods of that before, and generally what happens is you see this leadership change. When the internationals are underperforming the U.S., eventually the next leg up, the internationals outperform, and so on and so forth. Part of that slowdown we experienced in the international markets was not only the global financial crisis, but they also had a sovereign debt crisis. Remember when there was talk that Greece was going to leave the EU or Spain would leave the EU? So they had a double bump. They had two huge issues to work through. So we want to watch that. That lends a lot of analysts to write and opine on the fact that the international markets may very well show significantly better growth the next 3 to 5 to 10 years compared to the U.S. A lot of that is mean reversion. Let's turn our attention for a second to global trade. A lot has been written. There's been a significant amount of news regarding trade wars, etc. And a tariff clearly is a tax on consumers. The Chinese, my belief, doesn't pay it. The additional price is borne by the importers or the manufacturer or ultimately the consumer, depending on who in the value chain decides to raise their hand and say, hey, I'll pick up some of this. But the tariffs are effectively having an effect. And when you look at this fight between China and U.S., it certainly appears that we're better positioned longer term with respect to this struggle. When we simply look at exports as a share of GDP, the Chinese, nearly 20% of their GDP is created by exports, their ability to manufacture and export things. In the U.S., compared to all other developed nations, exports represent about 8% of our GDP. We build things here that are generally consumed here. So when you start looking at firing these salvos of tariffs, etc., we just simply have potentially more ammunition than they have. So that calls into question At what point do calmer minds get together and try to articulate some kind of treaty or agreement? If and when that happens, that'll have a hugely positive impact on the market and consumer confidence. So as we're kind of winding down on our talk for this quarter, let's look at the big picture. We generally, especially with our retirement accounts, run multi-asset, globally diversified portfolios. We also kind of call it a balanced with growth strategy. And many of you who meet with me regularly know what I'm talking about because I talk about this quite often. It's just better to dumb down highs and lows by having a diversified portfolio. Otherwise, you constantly run the risk of buying what worked well last year, which may, in fact, deliver disappointing returns the upcoming year. This chart depicts a number of different asset categories, ranging from cash to emerging market equity and just about everything in between. And we can see what the returns were in any one given calendar year, and then what a more balanced 60-40 global portfolio would have looked like. Significantly more consistent returns. The returns are kind of in that mid-range. There's nothing that stays at the top of the range for a significant period of time. And you do it with a whole lot less volatility, as is witnessed by the very last column. 10% average volatility versus 18% in small cap, or versus 22% or more in emerging market equity. The idea is to have a more balanced, diversified portfolio. It allows us the ability to hold our assets together in violent times so we have a base upon which to build on in the future. Well, that's it. That's essentially where we see things today as far as the economy is concerned. In closing, just a couple of housekeeping items. Hey, we now have 14 team members that work here with us, with me, on behalf of you, all our clients. So if there's ever anybody, friend, family, who might like a second opinion, a better look at what they're doing in conjunction with their goals and objectives, the amount of risk they're taking on in conjunction with how much risk they're comfortable with, we would love to be able to provide that second opinion. We have an elegant wealth process. We use multiple meetings. We review fairly regularly, and that's what we call maintain discipline. But to get there, we do a very detailed discovery meeting and then present our findings and decide whether we're working together, and then work collaboratively on our advanced plan and all the planning things, the discussions, the education we need to provide along the way. We do this with you. We'd love to do this with friends, family as well. And most importantly, the following several slides describe all of the definitions that were used in today's presentation and all of the risks involved in investing in any of the things described in the presentation as well. If anybody has any questions about any of this, any of the material presented, any of the definitions listed at the end of the presentation, by all means, please reach out. Otherwise, have a great remainder of the summer. We look to talk to you soon, and in many cases, see you very soon as well. And once again, thank you for having the trust and confidence in Kaydan Wealth Management. This is Jim Curzan saying, see you later.